Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host here for about the next 20 minutes here on Options Guide TV. Well, are the markets coming back? Are they not? There's a rose garden meeting that's going on right now that is about ready to get real, I guess. And we're going to learn a lot about the markets today. So it makes it a hard day to try to trade. We do have our positions on that are very interesting. So we went a little nutty on Monday's Options Guide TV, and we did a bearish put butterfly in the SPX and a skip strike put butterfly or call butterfly in the SPX. Both of them lean bearish. The skip strike, we use call options, but we did it for a net credit to the account. And then on the put butterfly, we opened a wing so that if the market did collapse and go beyond our strikes inside our butterfly, that we would still be profitable. And we are right in the middle. And that's exactly where we are located right now. So our risk or reward, if you will, for our butterfly with calls that we put on, we put it together on Monday. We did, let's run to the Tradier Pro software. We did the April 2nd expiration. So we did something that is going to expire today. We bought the 5,660 strike, sold two of the 5,670s, and bought one of the 5,690s. The VIX is up a little bit today, even though the SPX is up. And I think it has a lot to do with the news event. Usually the SPX is up just I guess you could call it flat at this point. It's up 0.1%. So we're up $7 in the SPX. And the VIX is at 2190. So this is kind of holding its own. We put it on for a net credit of 90 cents to the account. And right now it's trading at that same net credit to the account. So you could close it and remove the risk and be break even on the trade. Or we let it ride. So from this point on, time decay is going to be a very big issue. If we were doing this trade without the big rose gardening event that's going on, this is exactly where we'd want the market to be. A little bit below our long call strike. Market comes up and lands between 56.60 and 56.70. We're great, long as it doesn't go beyond 56.80. And we're in the SPX, so it is a cash settled index. You can't be assigned early. The settlement value will be determined by the end of the day today. So there's a lot of good things that are going on with this trade exactly where it is. And in particular, the fact that because of this known event on Monday, we were able to get the trade done for a net credit of 90 cents to the account. And I sent this to the what if calculator. So if you missed Monday's show, we'll review it here. And this is what the trade looks like, not to close it out, but the trade just in general looks like right now. You could actually put it on for, it looks like 75 cents. But every single minute that goes by, and it does not reach the 56.60 strike, this position is going to decay. So it'll be very interesting to watch if you haven't done a skip strike butterfly before. This is just a very interesting scenario that we have going on. So let me zoom in on the trade here. And here's where we're at. At 56.60, we get interesting from there all the way up to the middle point strike, which is 56.70. Now, we only went 10 points wide. And the biggest thing, the reason why we only went 10 points wide is we wanted to get it done for a decent net credit to the account. So if you remember, we build this as we're selling a short call spread to pay for the butterflies. In other words, the short call spread is the driver of this strategy. So we sold the 56.80s and bought the 56.90s. In theory, that would have been our short call spread that we would have put on. But effectively, by skipping the strike, that means that we used the credit from the short call spread to pay for the butterfly. And I try to say it as many different ways as I possibly can. And I try to explain it every time I do one because it's a hard trade to grasp. But that is the concept. Now, if we drift higher and we land between 56.60 and 56.70, then we're going to look really good on this trade. Now, if I have this position on, I am going to put in an order to get out. If we hit 56.70, I want to be out of the trade. I 100% want to be out, done, over. I don't want to take this risk of this market going against me and having a trade that's been a winner since we put it on, become a loser very quickly. So I want to be ready to react. And I do think the market's going to react on everything that goes on during that press conference. I think you're going to see highs and lows, and I expect volatility to be real today heading into the close. And so I would be prepared to know if that market went here. So first of all, we did it for a net credit of 90 cents. Here, I'm going to put in an order just to show you how to do it. This would be sell to close. Okay, so everything that's a buy becomes a sell. So we would go sell to close. We would go buy to close. And then we would go sell to close. Now I have to hit open because this is a test account. I don't have the positions on. And right now it's showing the debit of 90 cents. Now I personally would try to get this done probably for a credit, because if we start going in this direction, and vol's got to come in a little bit though. We only have till the end of the day today for these options to live. So time decay, like I said, it gets real from about noon until 4 o'clock. You get so much time decay in the S&P 500 index option contracts. As a matter of fact, I don't mind this trade right now if you want to put it on. I don't mind it, considering you still got the pumped up vol. You're still getting it done for a net credit of around 90 cents. And you want to, in other words, I don't mind doubling up on this trade where this market is at right here. Now, as far as the markets are concerned, they're just trading flat. And I think everybody's just kind of anxiously waiting to see if we get some clarity. And I think the biggest thing today, in my opinion, and this is, if you listen to any of the financial networks or shows, not a lot of people are worried about the actual tariffs, if you will. They think that the businesses can adjust, but they are nervous about the fact we don't get any answers. In other words, the can gets kicked down the road. There's more uncertainty as far as the markets are concerned. And are we going to have tariffs? Are we not? If it's perceived that we're getting some answers, I think the markets will have a good move to the upside. Now, that's a lot of thinking, right? That's just an opinion from somebody that watches way too much financial news overall. But that's the way I kind of feel about it. And the fact that this thing is still trading for 90 cents, we do that as a net credit, enter it right now, and you got 30 points before your risk starts hitting in. As a matter of fact, it could go up 40 points from this point, and you'd still be okay. But if it does go up beyond 56.90, you have a $1,000 requirement, and you can lose that. So that's a real number. So I like the fact that you can trade out of it. You could put it on right now and take it off a half hour later at 56.70, and you'd probably be at break even. I would assume, but that's what I really like the way this. As a matter of fact, I'll probably put this position on once we get off the show, just to be able to watch it today. And always manage your risk. You remember there's $1,000 requirement on this trade, so a 10 lot is 10 grand. So just be aware of that. Okay. Anybody have the position on? If you have any comments or questions, please do put them in the chat box. Now, here's the other side of the coin. And on the other side of the coin, we have a trade that's not working out the best for us. And this is our open wing put butterfly on the downside here. So if we put this trade on, we're going to add this. We'll send this one to the ticket. So it's down below 47. Wow, now it's 22 cents. Okay, so time decay is starting to hit this one really hard. 55.40 is where the market would have to come down to. We're at 56, so we got to come down 100 points in the SPX. And there's major news that could happen. You could try to adjust the trade, but there's not really much of an adjustment, and it would make me a little nervous to do it. But here would be, let's see where those are trading at. Okay, we got rid of the other ones. Yeah, here we are. 56.40. Okay, that's $1. So the only real adjustment that I would make on this trade is you would sell the 55.40s and you would buy the 55.15s. And then in that situation, you're going to have two short put spreads. And I don't think that's worth it considering what's going on today in the news events. Okay, so the adjustment, and I'll just show you the adjustment, but I don't think it's a wise trade. So we're going to get rid of this. But since there's so much time decay, this might have made sense in the morning or going into the close yesterday. But here's the adjustment that I've done many times when I've ever had a bearish put butterfly on, is you just roll it into a bull call spread. So here's what we would do is we would end up selling to close the 55.40s, the most expensive option contract, and then buying to open the 55.15. And you can get that done for, we'll say 65 cents. Okay. We'll just click on that. If we can get it done for 70 cents, you're going to add $2,000 worth of risk to this position, and you're going to bring in 70 cents for that $2,000 worth of risk. And you're only going to bring in $70 overall. And like I said, and I don't think a lot of people will even know after the event exactly what the market thinks of the comments and what happens. But yeah, that's where we're at. Okay, so if you put this on and you rolled it, if I were going to do it like yesterday, you could have probably got this done for $3 or $3.50, and it might have been worth doing. Right now, it's only $70 if you do the one roll. So you're talking about $350 versus $70 to put on $2,000 worth of risk. I don't want to do it now, but this would be the adjustment. Okay. And then what your position would end up with, if after you did the roll, is, remember, you have two of the 55.20s. So in the end, you're long two of these. No, you're short two of those. Sorry. And long one of the 55.10. Oh, two of the 55.10s. Okay. So you would want the market to stay above 55.20, which is 110 points in the SPX right now. Market is flat. So the market is really just waiting for news. That's simple, the way it looks. Okay, so that's how you would do the roll on that trade. But that trade we paid $2.60 for, or $260. We brought in 90 cents from the credit spread on the skip strike butterfly. The net credit was 90 cents to the skip strike butterfly. Now, hopefully, we can make another at least $1.40 on that skip strike butterfly to pay for this butterfly. But as of right now, I'm just going to stay the course. I would leave this entire position on, and I am probably going to set up that trade, and this will be the paper trade for the day. I like this trade right now. Let's see what we can do. See if we can get 15 points wide for minimal dollars. Okay. So here is our skip strike here. Send a ticket. So now it's only 70 cent net credit. Got to get the trade on quickly. Let me run here. And I was going to I keep promising to set up this trade in NVIDIA, but I just don't get to it. 50. So now we're up just a smidge, 56.60, 56.70. Okay. Right here, I totally would do that for 60 cents. Totally get that trade in for 60 cents right now. Now, if you clear this out, see what happens if we go 15 points. Buy, sell to, and then we got to add, we're going to add some risk on here though. 15, 80, 90. Is that 30? Yep. 25, 30. Yep. And that needs to be a sell. $0.05. All right. That's interesting too. Okay, so the other trade you could get on for 60 cents net credit, and if the market stays where it's at or drifts lower, you could be profitable on the trade. Now, if you go 15 points wide, which gives you a heck of a lot bigger landing spot, it looks like you can get it done for almost a dime, or even isn't bad at zero if you did it right there. But a dime is very interesting. Oh, I flipped a script. Dang it. Okay, so this would be the buy. So it's you got to pay a little bit for it. I don't like that. So 2 cents, 3 cents. So you'd have to pay a dime to put the trade on. I don't know which one I like better. If I would rather do it for a net credit and only have a 10-point wide landing area, basically, on our long spread, or do I want to have a 15-point wide landing area and have 4 hours to trade it? Now, if you do this, you're going to be watching it, and you're going to have an alert set in your head at 56. Well, here in our instance would be 56.75. My computer's froze right now. There we go. That happened. Okay, so we're right here, and if we land right there, so here's the biggest. Here's what my thinking is, and I'm doing a lot of thinking while we're putting this one together. If the market gets to 56.60, you are 15 points away from the 56.75. That means that option contract is going to be decaying a lot more than if we go 5 more points in. Time decay, big thing here. So, oh man, it's a credit now. Yeah, if I get that done for 20 cents, I'm doing this one. Where's the SPX at? Oh, it just moved. There it's happening. Yeah, it just went from up 2 to up 14. All right. Well, I think we're gonna call this. What an interesting trading day. 20 cents now on that skip strike, 15 points wide. You definitely want to have an alert on if you're going to do this trade. And this would be an interesting trade today because you have 4 more hours left in the day, and we just can't let the market go above 5,700. Well, we actually don't on this one. We don't want it to go above right here, which is, what is this? 5690. 5690 is where our risk comes in. All right, everyone. Do you have any questions? I should look at that. All right. So on Friday, we'll do the NVIDIA trade without a doubt. I keep promising to set up the covered call on steroids is what the name is, I guess. And that was given to it by the internet. That's the only way I've really heard of it. But it's an alternative to a covered call. And I'm got the position on in NVIDIA right now, and I'm going to continue to do it. I've done it ever since the downturn. Already cashed out once on it, and then it's gone down, and one expired worthless, which was good because it was done for a decent net credit. And now I'm going to do another one because I am ultimately bullish on NVIDIA long term. So trying to do something in the short term to make some extra bucks based off of the volatility. And that will be the show on Friday, 11 a.m. Eastern time. If you have shares of an NVIDIA, this will be a story about hedging that underlying stock. Even if we get a little bit of a bounce today, it will still be valid just because volatilities are going to remain high. And that opens up opportunities to do something above and beyond just selling a call option outright. That's it for this edition of Options Guy TV. We'll see you this Friday for the next edition of Options Guy TV, and we'll see where the markets land this week. Hopefully we'll get an up week and, stop the bleeding, I guess, as far as the markets are concerned. Thanks for tuning in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.